What's going on, everyone? Welcome back to the Courtside Financial Podcast. And if you tuned in yesterday expecting a victory lap today, well, the market had other plans. Yesterday, we talked about NIO's Phoenix-like rise, how they kind of hit these lows in the $3 range back in April, and since the stock had seemingly doubled. We talked about how the company was finally speaking the language of sustainable business, the L90 and ES8 success, along with the NT 3.0 platform. Things that really looked like institutional learning in real time. 24 hours later, reality just served us a $1 billion reality check. Let's cut straight to what happened. NIO priced a $1 billion share offering at $5.57 per ADS at an 11% discount to yesterday's closing price of $6.28. Stock price dropped just under 9% today, sitting at $5.72. And you know what? Every single person who's been following this company saw this coming from a mile away. But here's what's fascinating about market psychology. We can intellectually understand that a cash-strapped company needs funding, celebrate their operational improvements, and still feel gut punched when they do what they need to do to survive. This isn't NIO's first rodeo this year, folks. Back in March, they raised $520 million in an offshore offering. Now they're back for another $1 billion. In the comment section as well, let's just say this is one of the kinder descriptions I saw. Let me put this into perspective though. Despite today's just around 9% drop, NIO is still up 16.5% for the month and around 25% year to date. But here's the thing about dilution. It's not just about the immediate price impact. It's about the long-term value destruction when a company continuously taps the equity markets from a position of weakness. Every time NIO does this, they're essentially saying, we believe our growth will compensate for giving away a piece of the pie today at depressed prices. Sometimes that bet works. Sometimes it doesn't, but it's always made with shareholder equity on the line, and I'm a shareholder. Remember yesterday we talked about NIO only having 11.9 billion ren in cash? For a company burning cash while scaling production, investing in R&D, building out their battery swapping business, that's not a comfortable cushion. It's survival money. But let's zoom out and look at what's happening across the entire automotive landscape, because NIO's not the only one reaching into investors' pockets. Volkswagen just announced that they're investing 1 billion euros in AI development by 2030, expecting a 4 billion euro cost savings by 2035. Think about that ratio. Invest 1, save 4. That's the kind of return on investment that makes CFOs salivate and boards approve massive pricing programs. This isn't just about electric vehicles anymore. We're watching the entire industry turn into technology companies who just happen to make cars. In technology development, well, it's capital intensive. Whether you're NIO developing the NT 3.0 platform or Volkswagen developing robust AI systems, you need cash. Lots of cash. Now, the difference is that Volkswagen can fund their €1 billion AI investment just from operations. NIO, on the other hand, they've got to go to the equity market. That's not moral failing. That's the reality of being a growth stage company in a capital intensive market like this. Here's where yesterday's Phoenix rising narrative gets complicated. Everything we celebrated about NIO's operational improvements, the cost structure reform, the focused strategy, the institutional learning, all of that is real. The ES8's $30,000 orders in a matter of days, that's not a mirage. The L90's precision market positioning, that's not fiction. But none of that changes the fundamental financial equation. NIO is still losing money while investing heavily in future capability. You're still racing against time to achieve sustainable profitability before the piggy bank is empty, before the cash runs out. And in that race, equity dilution isn't failure, it's strategy, it's a tool of survival. The frustration in the comments isn't wrong, it's just incomplete. Yes, dilution hurts existing shareholders such as myself. Yes, it's painful to see your ownership percentage shrink with each offering, but the alternative, letting a company with genuine operational momentum run out of cash, that's probably worse for shareholders. Let me share something though that's been bothering me since yesterday's analysis. We celebrated NIO's strategic awakening, but we might have undersold just how difficult execution is for this company. Look at their 2026 pipeline: ES9, the 5-seater ES7, the L90. That's only 3 models. Meanwhile, XPeng is planning comprehensive platform rollouts. BMW is accelerating their EV lineup globally, and Tesla's being Tesla with massive scale advantage. NIO's measured approach might be financially prudent, but in a market where momentum is everything, conservative product planning, it could be strategic suicide. They're managing scarcity when they could be leveraging the momentum. So what's the real story here? NIO's managing what I call the Phoenix's price, the cost of resurrection in a market that demands momentum. They genuinely improved their operational capability. The market recognition of that improvement drove the stock from the $3 range to the $6 range. Now we're in the high fives. That's another story. But that success created its own problem. Higher stock prices mean lower dilution when you raise capital, but they also create higher expectations for sustained performance. NIO needed this capital to fund the very improvements that we celebrated yesterday. The NT 3.0 platform, the supply chain optimization, the expanded product capacity, none of that comes for free. They're essentially asking shareholders to fund the transformation that we all want to see happen. For NIO investors, this is the moment of truth, not the product launches, not the delivery numbers, not even the stock price recovery. This dilution event is where you find out if you believe in the long-term thesis or you are just riding the momentum. Because here's the hard truth: if you believe that NIO can achieve sustained profitability and market leadership, then this dilution is and should be just a drop in the bucket or an investment in the future that you should be believing it. If you don't believe that, then every equity raise is just postponing the inevitable. The proceeds are going to R&D, charging infrastructure, platform development, and general corporate purposes. In other words, they're investing in the exact capabilities that we said that they need to develop yesterday. But let me tell you what I think this really signals about the EV market in 2025. We're in the last mile funding phase for many of these companies. The easy venture money is gone, the SPAC money is gone. The only money available now is from the public markets and strategic investors who demand real business fundamentals. Companies like NIO that can still access markets at reasonable valuations, they're survivors. Companies that can't, well, we've seen what happens to them. Volkswagen's €1 billion AI investment isn't just about technology, it's about having the balance sheet to make massive investments on future capability. NIO's $1 billion equity raise is about earning the right to do the same in the future. They're starting from a much smaller base. They're not as big of a company as Volkswagen. They don't just have the cash to deploy like that. They've got to get it from somewhere. And that's what everyone should understand when they invest in a company like this, so it doesn't feel like someone's putting a thorn in your side every time capital is raised. So after the past 48 hours, here's my take, and I'll just keep it very simple. The company's transformation, it's real, but it's fragile. Today's dilution doesn't negate yesterday's operational progress. It does, in fact, the opposite. It funds it. So anyways, that's it for this episode of the Courtside Financial Podcast. I hope you found this useful, informative, educational, at the very least entertaining. If you found it to be any of those things, hit the like button, hit the subscribe button, notification bell icon, leave a comment down below, share the video. All your engagement really does go a long way in helping out the channel, helping us serve more people, getting this information to them and reach a broader audience. So we'll see you in the next episode of the Courtside Financial Podcast. Happy Wednesday. This is Obi signing off. Goodbye.